Hot dividend stock, everyone. I am so excited. I bought more shares of IBM. I'm going to discuss that in today's video and how buying more shares of IBM is an interesting, awesome, deep discount opportunity in my humble opinion. I'll tell you, this last week was a little bit of me against the world. As one of my favorite rappers, Tupac, said, you'll see in the video to follow this intro. I filmed it last night. I discussed this topic a little bit of how dividend stocks, despite having a me against the world type of week, they give me power. Buying shares of IBM gives me power, and it can give others power in my very humble opinion. Get ready for an exciting video about dividend stock investing. Dividend growth investing, I have a really special video for all of you today. I want to talk about two dividend increases that happened this week. Kimberly-Clark and Air Products and Chemicals. Two dividend increases. I'm going to share numbers behind each of them and what it means for yield on cost. I want to show you examples in real time, the numbers that illustrate my experience with yield on cost and how it's a life-changing concept and how dividends have so much power. So I'm going to go through that in the agenda today. I want to talk about two stock purchases that I've made recently. I just made my second tranche purchase of Wells Fargo, and I have not even announced this on my Twitter or anywhere. I wanted to leave something for the videos, just exclusive to the videos. I bought some more shares of IBM, so I'm going to talk about that today as well. And not only am I going to talk about those purchases, but I want to get into some of the philosophy behind it all. I'm averaging into Wells Fargo right now, and it's very similar to what I did with 3M. So I want to share my dollar cost averaging strategy with you all and some numbers, some mathematics that I experienced with 3M and why that strategy of dollar cost averaging dividend investing works so well for me. When it comes to IBM, I just want to get into some of the numbers. Everyone has counted this thing out. Everyone thinks that it's all over for Big Blue. I want to get into some of the numbers because I think the numbers from their recent earnings report are awesome. They are stellar. They just announced the fourth quarter 2019 results and the full year 2019. It was a bright year in my opinion and a bright fourth quarter for IBM. Excited about that. Glad I picked up some shares right before the earnings report because I've already experienced some upside, although I hope it stays down longer because I want to accumulate more IBM in 2020. I'm excited about this stock. And quite frankly, this has been a long week for me. It's Friday night. I'm kind of tired, but I got to do the video because this video is about the power of dividend growth investing, and the concept that I want to share with everyone that I really want to bring home is that no matter how difficult your job is, no matter how stressful of a week you had, no matter if, hey, maybe you didn't get the respect that you deserve at your job this week, or maybe you never get the respect you deserve at your job, when you are a dividend investor like me, I own these companies. I own all the companies just mentioned. I own Kimberly-Clark. I own Air Products and Chemicals, 3M, Wells Fargo, IBM. I own these things. And so who gets the respect out there? Who gets the benefits of the company? Who gets the upside? Who gets the dividends? Who gets all the good stuff? It's the owners. And so the thing I want to hammer home, and the reason I'm doing this even though I'm so tired, is that is such an exciting concept with dividend investing. Dividend investing is powerful. If you're a dividend investor, you are, in my humble opinion, a winner. You harness that power pretty much right away. And so we're going to talk about some of that power in today's video and what it brings to my life at least. Get ready, everyone. Exciting video today. All right, so I want to start with Kimberly-Clark. This is one of the companies that I was accumulating in 2018, although I've been buying this thing forever. It just so happened that it was on sale in 2018, so I was adding more shares strategically in 2018. But I've been buying this company since a long time ago. In fact, since 2011. And so Kimberly-Clark, I'm going to share some numbers on the screen right now with all of you. They just announced a dividend increase, and it wasn't a huge dividend increase, but they increased the quarterly dividend from $1.03 to $1.07. So it's up 3.9%. I want to share this with you. I first started buying Kimberly-Clark in 2011. I initiated my position at $63.54. Fast forward to now, January of 2020, it's at $143.42. I am up 126% in terms of capital appreciation alone, not counting dividends, just looking at the raw stock price. And so this is awesome. Now, the dividends per year on the new dividend rate of $1.07 per quarter is $4.28. That $4.28 divided by the current share price of $143 gives a starting yield of 2.98%. So not that huge of a starting yield. I'm not buying any Kimberly-Clark here. I don't think it's on sale right now. I don't think it's a bargain stock right now. But check this out. My yield on cost on Kimberly-Clark on my first tranche 2011, if I take the $4.28, I divide by what I paid for the stock, which was $63.54, I am doing a Thug Life dividend yield on cost of 6.74%. Now, that is a simple yield on cost. It assumes over all these years that all the dividends I received, I just spent them. Now, we know that's not the case. I've been faithfully reinvesting all of my dividends back into Kimberly-Clark over the years. And so my real yield on cost is even better, but I'm just using this for the math to make it simple today. My simple yield on cost is the 6.74%. And so a lot of investors think dividend investing, these starting yields, they're really low. Kimberly-Clark, it's paying a really low yield. I can't pay bills off of, say, 2.98%. But when the yield on cost gets up to a 6.74, hey, you can start paying bills on something like that. And look, that's in less than 10 years' time on a very large, kind of slow-growing blue chip company. Just think what's going to happen after another 10 years passes. Really, really amazing stuff if they can keep up the great dividend growth and the great numbers at their company. And so this brings me power right here. This brings me hope. This brings joy to my life because I can already see after less than 10 years, the fruits of my labor with Kimberly-Clark getting to a point where if I wanted to start tapping into cash flow, paying bills with it, I'm not quite there yet with Kimberly-Clark. I could. And so it's exciting to see it getting to that point, and it gives me power as a dividend investor. And really where the power comes from, quite frankly, is finding a quality company, starting at a reasonable valuation, dollar cost averaging in, and letting time do its thing. A lot of the power that I have comes from my patience, my persistence, and the time, just the time that has elapsed since 2011. So check this out. The analyst estimate EPS this year, 2020, is a 7.25. And so what's the PE ratio at the current price? If I take $143.42, which is the current share price, I divide by the 7.25. A current PE on this is 19.78. Not trading, I would say, very overvalued, but certainly not undervalued. I'd say it's probably fairly priced, if not a little bit overpriced. Maybe the PE should be more like an 18 at a fair valuation for something like a Kimberly-Clark. However, my PE ratio on my purchase price, if I take my original purchase price, I divide by the 2020 estimated EPS, it's an 8.76. Let me repeat this. If I take the $63.54 I paid for this thing in 2011, I divide by how much they are expected to make in 2020, which is 7.25. The result is 8.76. And so I have power here because I bought this thing so long ago that my PE ratio on cost, just like my yield on cost, is very favorable. And then I start looking, oh, the market's going to collapse. There's all this fear out there about a correction, this and that. I start thinking, is Kimberly-Clark ever really going to get down to that $60 range again? Is it ever going to get down to a range where it's like an 8 PE? No, I don't think so. It would take something really major for that to happen. And so it gives me confidence. It gives me peace. It gives me, quite frankly, this concept of accomplishment. And so what I'm trying to impart on you is, hey, maybe you had a long week at work. Maybe certain aspects of what you're doing, you don't always feel like you're getting the fruits of your labor or the rewards. The exciting thing about dividend investing, quite frankly, is this. It's very much this. It is something that is entrepreneurial. It's something that's accessible to everyone. With brokerages now, like Charles Schwab, for example, offering commission-free trading, brokerages starting to offer the ability to buy fractional shares, free dividend reinvestment, all of that good stuff. Dividend investing, stock market investing is becoming accessible to everyone. And I believe it is the power. It is the power that anyone can tap into, that can harness into if they have the dedication. They have the ability to learn how to analyze stocks. They have the ability to enter at the right purchase price, and they have the ability to wait it out, to do the tough stuff, which is consistently deploying money and waiting it out over the long term. And this is so powerful because it is motivating, it is entrepreneurial, it is the path for literally anyone. It is for everyone to become a business owner like myself and enjoy the benefits that come with that, which are massive passive income and cash flow, like I am starting to see after owning Kimberly-Clark all of these years. And so that, in my opinion, is one of the most motivating reasons I do this. I love dividend investing. So I want to talk about the next stock that just raised its dividend. This one is Air Products and Chemicals, ticker symbol APD. I don't talk about it too much here. I first started buying this stock back in, when did I buy it? 2013. So it's been a while, not as long as Kimberly-Clark, but a while. And it's so interesting, Air Products and Chemicals. This community, we are 50,000 subscribers strong now. I love you all. Thank you for the support. We are growing. We are having meetups. We are awesome. And I love this community. And I love the community not only here on my channel, but the broader dividend community. And I want to give you an example of that. Mr. Free at 33, Jason Fieber, I hope you're watching. He is one of the greatest investors, in my opinion, out there. He's an amazing, amazing investor. And not only is he an amazing investor, but his life story is so fascinating, so interesting, and what he has accomplished is just out of this world. I've mentioned this before, but I just got to do that shout out again because he's one of a kind. Anyways, back in the day in 2013, he is someone in the dividend community who was talking about a stock, Air Products and Chemicals. I'd never heard of this stock before. And so I started looking into it. I did my own fundamental research. I really dug into the numbers. I like what I saw. I also bought some Air Products and Chemicals, and that's what I'm going to talk about now. But before I do that, the overarching theme here is twofold. There's power in the community, and so this community is for everyone, whether you're on my channel or the broader dividend community. And one of the great things about the community is we all learn and benefit from the community. I benefit, you benefit, Jason benefits, everyone benefits because we're all part of the community. And one of my favorite things about this channel and the broader community is when new stock ideas surface, things that I can dig into. A lot of them don't work for me. They may work for other people, but once in a while I'll find a pick out there that I didn't know about that just so happens to fill a void in my portfolio like Air Products and Chemicals does, because I had no exposure to chemicals. I look into it, I'm like, wow, this is something awesome that came out of the community, and I did my research and I'm going to go for it. So one, I want you to be aware of the power of the community and the value that is there. But two, I want something really key to resonate with all of you. I didn't just go and buy this stock because Jason bought it. I didn't just go buy this stock because Jason bought all these stocks previously and they all worked out for him really well. I want you to think about this because I just did a video celebrating 50,000 subscribers, and I went through a lot of the stocks that I've brought up on this channel that I've bought and how well I've done. And I think a lot of people start seeing stuff like that and they start thinking, Ian cannot go wrong. Ian can't go wrong. And the risk that comes with something like that is the last thing I want is people just to follow what I'm doing. I'm sharing my own journey here on YouTube. My journey is only my journey. It works for me. It may not work for other people. And so likewise, Jason's journey, it's for Jason. But sometimes journeys can overlap. And the key point here is when you find something from the community, whether it's from my channel, Jason's blog, anywhere in the community, other folks in the community, just be careful to do your own research. Do your own research and really dig into the numbers and come to your own conclusions. That's so important. So again, there's power in the community, but with that power, you have to kind of respect the power and do your own research as well. Anyways, shout out. I bought Air Products and Chemicals. I got into this awesome company at, when did I buy it? I'll share this on the screen, $95.02. And it's now at $243. And so I'm up 157%. Capital appreciation, not even including dividends. But here's what's so exciting about this stock. They just raised the dividend by 15.5%. Let me repeat that. Air Products and Chemicals just raised the dividend from $1.16 a quarter to $1.34. That is a massive dividend increase. And what I love about this company is it's a quick dividend grower. The current starting yield, it's never that high, but they have a track record now of raising this dividend very aggressively. And so what does that mean? If I take the annual dividends of $5.36, I divide by my purchase price of $95, I'm yielding 5.64% on cost. Simple yield on cost, not including reinvested dividends. And again, over the years, I've reinvested a bunch of dividends, which has snowballed my income and my results even more. I've talked about that in other videos on my channel. But again, I'm just sharing simple yield on cost here to keep things simple for the illustrations today. Now, what's so exciting about this thing as well is check this out. 2020, analysts expect them to earn $9.44. The PE right now is a 25. Why is the PE so high? One, because the overall market is trading at very rich values. But two, this is a quickly growing company. It's growing quicker than Kimberly-Clark, for example. And so a lot of that growth, it's priced into the PE ratio. It has a higher PE ratio. But check this out. If I take my purchase price, I divide it by 2020 estimated earnings, what is my PE ratio on cost? It's a 10. And so payout ratio, by the way, on both this and Kimberly are really good. And so the message here, again, is this is power. There's power because I got built-in gains. I've been doing this a while. I've hustled it out. I've been in the game. I've been in the game for a long time. And so because of that, I got the high yield on cost, and I have the amazingly low PE ratio on cost. And what does that do? It allows me to sleep at night. It allows me to enjoy the benefits of my hard work, my dedication, going through all those hard years of just waiting, working, deploying capital, but it pays off. And so again, this is a microcosm in some ways of the entrepreneurial journey in my opinion. Being a dividend investor, in some ways, it's like being an entrepreneur. You're building the portfolio, you're putting in the sweat equity, you're putting in the hard work, you're working a job that's really hard at sometimes to get money into the dividend stocks, but at a certain point, you start seeing the fruits of your labor. It doesn't happen necessarily year one, year two. It starts happening, say, 5 years out, 7 years out, 10 years out. Certainly after 10 years, you really, really start seeing it. But the message here, it's a positive one. This is power. There is power in this because it is literally the entrepreneur making sacrifices, the entrepreneur putting in the money, putting in the time, putting in the research, waiting it out, deploying the money, having the faith in it all, and then seeing the results, seeing the value after all of these years. And so I know a lot of you watching now, you're like me. It's Friday night. You put in a hard week of work. You're kind of thinking, what's ahead? What's ahead for me in my life? What's ahead for me in my future? Maybe you're just starting out with dividend investing. Some of the dividends are rolling in, but you're not seeing all the benefits yet. I'm trying to give you a preview of the power that is coming your way with this stuff over time. And so it's just so exciting to see this coming to fruition right before my eyes with some of these stocks that honestly I haven't even owned that long. Kimberly-Clark since 2011, Air Products and Chemicals since 2013. Bless these organizations. I'm proud to own them. I am proud to be an owner in these companies. And so I want to switch gears here a little bit. I want to get into the next topic. I want to talk about some stocks, some stock purchases, and I want to use these purchases to also convey some insights to the community right now that are related to these purchases. So as you know, Wells Fargo, I bought tranche 1. It was somewhere in the 49 range. I'll link in the description below. Did a whole video comparison analysis of Wells Fargo and the other banks. I love Wells Fargo. There's a lot of drama around it. Seems to be a lot of negatives. Obviously, the numbers pan out, but it's this negativity around it that really gets me excited, because even the investing community, they hate this thing. They're saying it's bad, this and that. Oh, I love hearing that kind of stuff, because when the pessimism is there, that's when I see opportunity for myself. Just sharing my personal journey here on YouTube, obviously. And so, bought some more Wells Fargo. I bought tranche 2, and I got tranche 2 in the 48 range. So I'm going to share this on the screen right now. Bought my Wells Fargo, $48.34, and it's actually already down from that. I bought it, I don't know, a day ago or so, and today is down at $47.57, so I'm already down. Good. I personally believe that this thing is trending probably down to the 44, 43 range, and I'm going to average all the way down, all the way back up, just like I did with 3M. I'm going to share that example in a minute, and why I love that dollar cost averaging strategy. Dividend is $2.04 a year, and so I'm buying this thing at a 4.22%. And the expected forward PE ratio for 2020 is an 11.79. Is it in bargain basement territory yet? No. Is it at a value where I feel good buying it, adding exposure to the banking finance sector, which quite frankly my portfolio lacks? Yes. Why am I going into it now? Why am I not waiting a little bit longer if I think it's going lower? There's really a few things that go into that. One is it's impossible to time the market. I just don't know where it's going, and I feel it's at good enough value now to start buying. So that's one. But two, I want to stay in the game. I like to always be deploying money because it keeps me focused on the goal. It keeps me feeling empowered, if you will. Just like looking at those two examples I just shared with Kimberly-Clark and Air Products and Chemicals, it's incredibly empowering because I see those results so far. I start thinking, Ian, keep hustling. What's it going to be in 10 years? It's going to be amazing. And so that creates power for me. But what also creates power for me is just getting money to work for me, getting it literally in the market, making the purchases, just doing it. That's my strategy, at least. And so kind of what I do, someone's asking me, Ian, how many tranches of Wells are you going to buy? For me to get to full size on this position, which might be, say, 0.8% of my portfolio, 0.9% of my portfolio, somewhere in that range, I'll probably make, say, 10 purchases, something like that. Although if it dips really suddenly, say to 43 or 44, I might just go real heavy and I might only need, say, 5 or 6 purchases to build it to size, because if it dips really quick, I'll just go big. I'll just deploy all the money at once. I'll just make it happen. But if it kind of does what it's doing, which is a slow decline and then kind of a slow rebound, it'll be much like 3M. It'll take some time to deploy the money. And why I like doing it this way is it optimizes my chances of getting the best possible purchase price. I'm going to talk about that in a minute. But it also creates the power because I'm always deploying money. It makes me feel good about what I'm doing. And with everything that can happen in life, this is something that's always creates a lot of power. It's really empowering. It's really encouraging, literally just to deploy money. And so I want to share on the screen with you right now a case study of 3M and how I entered into 3M. This is really exciting. Check it out. What is so interesting with this case study is I didn't even look at this until today. I've bought 3M so far 16 times. Man, is that awesome. Thug life. And I started buying this thing years ago, and I started buying way too high. Even at the time I posted a video on it, I'll link to it in the description below. I had some people commenting, Ian, you're probably getting in too early. I knew it. I honestly knew it at the time, but I didn't care because I wanted just to own the thing. And I knew 3M, mind you, is a little different than Wells. It's a top 10 position for me. It's my number 10 favorite stock of all time. At some point, it might become like higher up on the list. I might trade it out with something else, such as United Technologies, but we'll see. For now, I'll just keep it at number 10. But the thing is, it took me to be a top 10 position. It means it's big. It's a lot of money I got to deploy. And so anyways, that's why it's 16 times. Wells won't need that many. But the point here that I want to illustrate with 3M is people always wonder, what if I get in too early and I lose a bunch of money? Well, that's exactly what I did with the first tranche of 3M. I bought this thing at $196.44. Mind you, right now 3M's trading at $178. And so I bought this thing at $196. I got in way too high. I bought a tranche, you'll see here, tranche 3 as high as $209. I got in really high. And mind you, this is such an interesting case study. My first 3 tranches were my biggest tranches. I bought 7.8% of my shares at $196. I bought almost 20% of my shares at $200. $200. It's trading at $178. I bought 15% of my shares, almost 16, 15.6 at $209. This is so important. I made every mistake in the book with this thing. I went real heavy, bought really high, and the thing just trended down. Now, what was my saving grace with 3M? It is the dollar cost averaging strategy. Check this out. I just kept buying. I bought more shares at 190, tranche 4. I bought more shares at 180, tranche 5. 179, tranche 6. 173, tranche 7, 167, 160, bumped back up to 173, 163, 160, 151. Tranche 13 was my best. Thug life. I got this thing at 151. I'm proud of that. It was only 5% of the shares, but hey, I'll take it. And then I started buying all the way back up, 166, 169, 176. Right now it's at 178. And so what you see here with 3M is, again, I bought too high. I bought way too high, and I went heavy. I bought a lot of shares too high. But what I did is I dollar cost averaged all the way down. And now it's on its way back up, I believe. I am dollar cost averaging up. I still think this whole range is fine. Hey, I'm happy buying in this entire range because I'm trying to build a big position. This is my number 10 favorite stock of all time. Yet I only started buying this thing, I think it was back in 2018, somewhere around there. So I haven't been buying it that long. And so what is the conclusion here? The conclusion is that by dollar cost averaging, instead of having my cost basis up, say at 196 or 200 or 209, my cost basis is 184. And the current share price is 178. And so check this. What is the overall capital appreciation on my average cost, not even including dividends? It's minus 3.6%. So not counting dividends, I have lost 3.6%. Now with dividends, I've basically broken even. I mean, I've been buying this since 2018. And so I got dividends from 2018. I got dividends from 2019. This thing right now is yielding roughly 3%. On the current price, 3.2%. And so the point is, if I factor in those dividends, I'm basically breaking even here. And I've been able to accumulate a large position in a world-class company over these years. But say I did not dollar cost average in. Say I bought it all up at 196, 200 range. On my first tranche, I would be down 9.3% if I just put in all the money at that time. And so what I want to share is in my last video, 50,000 subscribers, I dwelled quite a bit on all of my successes, and I've had a lot of them. But I would say out of all of the stocks that I have purchased in recent years, 3M, it's one of my favorites, if not the favorite, but it's not been a huge success yet. It's not. But my saving grace with it is the dollar cost averaging strategy. And again, dollar cost averaging is power. This disciplined strategy created power for me because it mitigated my downside. If I'd put in all the money at once, I would have had a lot more downside. But also, it kept me in the game. It kept me motivated just to keep going towards my goal. And quite frankly, it kept me motivated about 3M. It kept me really motivated because now I'm basically break even if you include the dividends. But say I was down more. Say I bought all the shares upwards of $200. I'm a seasoned investor, been doing this over 20 years, so would I be very demotivated? Probably not. I'd probably be really excited to buy more. That being said, I'm a little bit more motivated. It certainly feeds the ego that I'm basically break even rather than being down. And so the takeaway here, going back to Wells, is I'm doing the same thing with Wells. I think it's going lower. And so why put in all my money at $49? I'd rather draw a line in the sand, get my money working for me for the off chance that the thing skyrockets like PPL did. Because all you guys probably know, you've been following my channel for a while. I started buying PPL at $29, and then it surged into the mid 30s, and I've been buying all the way up. And so Wells, for all I know, might be like a PPL. And so I got to put a line in the sand and start buying. That's the risk, is if I just wait for 44, it may never get to my 44, but it could be like a 3M as well. And so just dollar cost averaging, it is the strategy for me. And obviously a downside of dollar cost averaging is if it is like a PPL, maybe I'm overpaying for it because I'm going to be buying Wells all the way up. But if Wells is more like a 3M, it's certainly dollar cost averaging is a really beneficial strategy. But what I've generally found with my investing, more stocks are going to be like the 3M case than are going to be like the PPL case, at least in my experience. And so the dollar cost averaging typically is the right strategy for me, at least for my personal journey. All right, so topic number 4 today. We've talked about Kimberly-Clark. We've talked about Air Products and Chemicals. We've talked about Wells and the dollar cost averaging stuff with the 3M example. I want to talk now about IBM. I'm excited about this one because they had a really stellar earnings report. I want to talk about that a bit, and I want to talk about my recent purchase, which is one of the rare ones I didn't share on Twitter, just because every now and then I want to have fresh content for the videos that is only available here on YouTube. And so check this out. I'm going to pop some numbers on the screen. I bought some IBM recently, right before the earnings, at $137.68. It's already up. It's already come up a bit since then. So I'm excited that I got in before the earnings. And analyst estimate in 2020 is a 13.38 EPS. And so that places the 2020 forward PE ratio at a 10. Let me repeat this. This is a special opportunity, in my humble opinion. It's kind of like an AbbVie type of scenario. You remember with AbbVie, I was buying AbbVie in the PE range of 7, and now it's higher. By the way, AbbVie has been coming down a little this week. I hope to buy more soon. I might even buy some next week, some more. It's coming down to the mid 80s again, which is exciting. And so we talked about Air Products and Chemicals. We talked about Kimberly-Clark. I'm just looking at stuff on my screen again. My PE ratio on cost for Kimberly-Clark, let's review this. It's an 8.76. My PE ratio on cost for APD is a 10. Mind you, I've owned Air Products and Chemicals since 2013, and I've owned Kimberly since 2011. Right now, in 2020, I can get a PE ratio on cost for IBM of a 10. Let me repeat that. I don't have to have bought IBM back in 2013. I don't have to have bought IBM back in 2011. I don't have to buy IBM at a current PE of 20 or 25 like the rest of the stock market. Right now, in this overvalued stock market that is 2020, there is a stock. It is called IBM, Big Blue, International Business Machines. This stock right now, I can lock in a PE ratio on purchase price of 10. Right now, I can buy it at that and say 10 years from now when their earnings have increased, my PE ratio on cost may be lower. It may be a 7. It may be a 5 for all we know. And so I see something like this and I get excited. I get so excited. I feel the power. I feel the power because in the market, even when the stock market is overvalued, I love investing in individual dividend stocks because there is always value. And IBM, in my opinion, is just that. And so check this out. Dividend per quarter is $1.62. Dividend per year, if I multiply that by 4, is a 6.48. The current dividend yield is a 4.7. Payout ratio is under 50%. They got a lot of room there. Now, keep in mind, they're not going to raise the dividend very quickly here at IBM because they're in process of paying down debt from the Red Hat acquisition. I'm going to talk about that in a minute. And so let's talk about that, actually. No, let's not talk about that. First, I want to go over some highlights. I got to go over some highlights 2019 fourth quarter. So I'm going to pop that on the screen for all of you. Check this out. This is from the press release from their earnings. I'm not going to go through everything, although everything on the screen here is pretty darn promising. I drew arrows to what I thought was most exciting on these highlights. What I am so excited to see is in the fourth quarter, cloud revenue was $6.8 billion. It's up 21% year over year. It's up 23% if you adjust for divested businesses and currency fluctuations, because you'll see in a minute, I'll talk about this. They do a lot of business overseas, and so they're dealing with international currencies, different currencies in different countries. A lot of folks think that IBM is a sleepy old business. A lot of folks think that their technology is old. A lot of folks think, hey, I don't see a lot of ThinkPads anymore. Keep in mind, most of what IBM does, you don't see on a day-to-day basis unless you actually work in tech. IBM is one of the leaders in cloud computing. Other than Microsoft and Amazon, they have one of the best clouds out there. I think I don't know what position they're in right now. They're not number one, but they're oftentimes bumping between positions 2 and 3 in the overall cloud race. What was so smart at IBM is they made the Red Hat acquisition. The Red Hat acquisition allows them to emerge as a real leader in what's called this hybrid cloud technology. If you're an expert in this stuff, by the way, put it in the comments below. Like I said, the value in our community being 50,000 strong is that I learn as much as you all do. And I learned so much from the comments, and we have subject matter experts in all of the industries here, more or less representing the community. So please share your insights on this. But what I see here is the Red Hat acquisition, which was a big risk, panning out. It's panning out successfully. Cloud revenue is skyrocketing. Sleepy old company, no, cloud is growing 21% year over year, even more if you account for currency. What I also like is so many people were worried, oh my goodness, they're taking on too much debt with the Red Hat acquisition. This acquisition, mind you, did not close very long ago. It closed on July 9th of 2019. They paid $34 billion. Since then, mind you, it has only been a half a year since they closed this acquisition. These guys have paid down $10 billion in debt. So we were all worried. They paid $34 billion for this thing. They've already paid down 10 of that, and they're going fast to pay down the rest. That's why the dividend growth in the next few years, the share repurchases, it's not going to be as much. Share repurchases are being paused until they pay down debt. Dividend increases, they're going to be slow. They're not going to stop their winning streak, but they're going to be slow. A lot of people don't like the company because Warren Buffett got out of it. I don't know. This is a case where I'm not so sure Warren Buffett made the right decision. I think I'm going to prevail here, and this is going to be a true winner in my portfolio. I think it's going to take some time, but I wouldn't be surprised 10, 20 years from now, my yield on cost is going to be really substantial, and my PE ratio on cost, it's already low. It's already at 10. It's going to be even better. And so when I look at what I'm going to do in 2020, I'm getting more and more excited about IBM. I just bought some. I'm going to keep on buying. And yeah, I never wanted to allocate too much to this company in my portfolio. My allocations are just going to get out of whack. This is going to be, this is going to move up. It's going to move up in the food chain. This is going to be a good position in my portfolio, a bigger one. And I just so see the value there, and I see their technologies panning out, even though the rest of the world doesn't want to. They don't want to. They want to see this thing fail. So check this out. I'm just going to share it visually now. This is from their deck. Thank you, IBM. They have a debt update. It goes and just visually shows you about $25 billion of their debt, mind you, is their global financing unit. They finance customers to buy their product. I'm glad to see that it's not growing, at least. I'd like to see that shrink over time. I don't like that practice, but it is what it is. It's one of the downsides. No company is perfect. If there's a downside with IBM, it's the debt and it's the global financing. I don't like it. But check this out. Pre-Red Hat close, they had $48 billion in core debt. Now it's down to 38. They are paying down that debt, and they have a lot of free cash flow, which I'm going to show you in a minute. And that is going to allow them to pay down even more debt. And so I actually want to do that now. I want to share some more highlights from their press release around their earnings. And so I'm going to toggle between these screens here as well on my computer. And you'll see here some highlights for the full year and looking forward for 2020. All of it looks good in my opinion. But what I want to highlight the most is the gap. 2020 EPS is estimated at least 10.57, which is the same as 2019. Hopefully they'll surpass that. But here's what's more important. They have free cash flow, $12.5 billion, and that's up. The free cash flow from 2019, let's see. I don't know. It's not represented. Oh, there it is. $11.9 billion. So this is the key point. Free cash flow is so important. It is so important because GAAP EPS, sometimes it has non-cash charges. GAAP EPS, sometimes it does not take into account capital expenditures and changes in operating capital. The free cash flow, in my opinion, is a really good way to look at how much cash the company actually really has to pay dividends, to pay down debt, how much cash is being generated. And what they're saying here, because GAAP, again, it's got non-cash charges. It's good and all, and I love GAAP, and it's important to look at GAAP because it's kind of the one number that a lot of accountants tell me is really hard to fudge, whereas with some of these adjusted numbers, they can be fudged. But check this out, $11.9 billion free cash flow in 2019. It's expected to go up to 12.5 in 2020. And so check this out. I want to share with you a debt analysis that I did. I want to see this core debt. How can they just pay it down? Let's look at the free cash flow and see how quickly, if they use their free cash flow, they can pay this debt down. So check it out. They paid $34 billion for Red Hat. We know global financing debt, $25 billion. Core debt, $38. So I want to see this $38 billion of core debt. Again, the global financing is different. It's related to financing customer purchases. Check this out, though. Free cash flow is expected to be $12.5 billion. We know in 2019 that the dividends were $7.1 billion. I just pulled that from the deck. That's how much they paid in dividends. Last dividend increase was about 3%. So let's say they do it again. Again, dividend increases going to be a little slower here. If I take the 7.1, I multiply by 1.03, it adjusts up to a 7.31. So let's say 2020, they pay $7.31 billion, something like that. If I subtract that out of the free cash flow, how much free cash flow do they have left after they pay dividends? I'm glad you asked. It is $5.19 billion. So, again, let me rewind. After operating their business, after paying salaries, after paying for marketing budget, after paying for office space, after paying for research and development, after making capital expenditures in the business, the cash flow that is going to be left in 2020 is going to be $12.5 billion. After you subtract dividends out of that cash flow, mind you, there's going to be no share repurchases. What's left? What's left is $5 billion. If we take that $5.19 billion, how many years would it take just to pay down all $38 billion that's left in debt? It would take about 7.33 years. So with a healthy dividend, with a reasonable payout ratio, with a growing business now, mind you, they are growing. Cloud is coming through for this company. Red Hat is coming through. They got a lot of patents that have been filed. They are the leader in that space. They got a lot going on with quantum computing and crypto, blockchain that literally may fuel future gains. Even after all of this good stuff, they got a lot of money coming through the door. And so what I foresee is a scenario where Red Hat, yeah, it looked expensive. It spooked a bunch of people, but they're going to pay down this debt. They're going to get really healthy on the balance sheet. And then once the balance sheet is super healthy again, they're going to go back to repurchasing shares and to raising the dividend, rewarding shareholders, all while growing this company again. And so I have a lot to like here with IBM. I know a ton of people are going to disagree with me. And I'm going to share one more thing I like about IBM is it's really international. We're talking about currency fluctuations. Check this out. I'll pop it on the screen right now. I took this from their investor presentation as well. You see in the top right-hand corner that when you sum up these numbers, basically 48% comes from the Americas. Now, Americas mind you, does include international outside of the United States of America, because the Americas includes North America, South America. And so even if you assume all of that comes from the US, which we know it does not, at most 48% is from the US. The rest, the 52%, is international. And so what I like about IBM as well, obviously global company, doing business around the world, global diversification, something to enjoy. And yes, it does create currency fluctuations and can make the numbers a little more difficult to analyze. And that's why I like how IBM in their reporting adjusts for those fluctuations to make things better for investors to analyze, like you and me. And so again, power. The power in all of this is, even in this overpriced stock market, I see value. And I see value in a company, quite frankly, that is turning the corner. And yeah, we've been talking about it. It's been turning the corner for years. And you know what? It may take another 5 years to actually really turn the corner. And I'm fine with that because I'll keep accumulating shares. Everyone hates it. Everyone makes fun of it. But you know what? I own it. And I'm proud to own it. I am an owner in this company. That gives me power. This company is already spinning off cash flow. It literally is big enough for me to pay bills with now. But just think about it. If they follow the path like APD, like KMB, imagine what the yield on cost on this thing could be in 20 years. Life-altering, life-changing, powerful. And so the message here is dividend investing. There is just so much to be thankful for, and so much power that comes out of it in so many different ways. And that's why that's the theme of the video today. But yeah, for the rest of this year, I'm excited. I have a lot of stocks I'm buying right now. You guys know my list. It's high yielders. I'll link to it in the description below. But as I think through my list, one stock that I'm just really excited about right now because of this earnings report is IBM. And look, there have been some false starts so far with IBM. There's been quarters where you think it's turning and then the next corner it's down. I think it's going to take them a while to fully get out of the transition they're making. But look, it is amazing and astounding how many times over the years this company has successfully reinvented itself. It's doing it again. I think Warren Buffett made a mistake. I'm going on record selling his shares. That's my understanding, is Berkshire Hathaway sold off their shares in IBM, or at least most of them. I remember that hitting the news. Hey, I'm happy to buy them. I'm buying those shares, and I think IBM is doing some good stuff, but I could totally be wrong. And I have had some luck and some success and some good fortune. My hard work is paid off. We've talked about this recently. I have been blessed. I don't know if that'll always be the case. Every stock pick may not go as well as the rest. Will IBM be like Air Products and Chemicals? I don't know. But I am willing to take that calculated risk because I know that is going to pay off for me and my personal situation in the long run. All right, everyone. Thanks for tuning in. Friday night, being real with you all, Thug Lifestyle here, PPC Ian. Let me do my disclosures. So before I leave today, I want to share that I own the stocks. I am long. I own the stocks mentioned today. So I am long. I personally own all of the stocks mentioned today, including Kimberly-Clark, ticker symbol KMB, Air Products and Chemicals, ticker symbol APD, Wells Fargo, ticker symbol WFC, 3M, ticker symbol MMM, IBM Big Blue, ticker symbol IBM, United Technologies, ticker symbol UTX, PPL Corporation, ticker symbol PPL, and AbbVie, ticker symbol ABBV. I own all of those stocks in my personal dividend stock portfolio. Also, before leaving today, very important to note that today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for your fun and entertainment. And I have more disclosures, disclaimers, as always, in the description below. Please take note of all of those. Our market is at historically high levels. There's probably more risk in the market right now than before, but I personally, for my personal journey, still feel incredibly empowered. All right, everyone, have an amazing, amazing weekend, week ahead. I love you all. celebrating 50,000 strong. I have a backlog of about 500 people I have to approve to the Facebook group. I will get through it. Thank you for bearing with me. I wrote the first chapter. It's actually not the first chapter in chronological order, but it's the first chapter on paper of my book this week. I'm so excited. I'm in writing mode. I'm getting that book done for all of you. I love you all. I'll see you in the next dividend investing video.